Compaq did something almost impossible in the history of technology. It challenged IBM when IBM looked untouchable. It helped turn the personal computer from a controlled corporate product into an open global market. And for a moment, Compaq was not just another PC company. It was the company proving that the future of computing did not have to belong to IBM. But that is what makes the story so interesting. Compaq did not collapse because it was weak from the beginning. It collapsed after it had already helped create the very market that later made it harder to survive. In the early 1980s, the personal computer business was still young, expensive, and uncertain. IBM had the brand that corporate buyers trusted. For many businesses, buying from IBM felt safe. It was not just a computer purchase, it was a career protection decision. Compaq saw the opening inside that fear. The company was founded in 1982 by Rod Canyon, Jim Harris, and Bill Murdo, three former Texas Instruments executives. Their idea was not to invent an entirely new kind of computer. It was to build a machine that could run the software made for the IBM PC while giving customers an alternative to IBM itself. That sounds simple now. At the time, it was a dangerous idea. The real product was not just the hardware. It was compatibility. Business customers had already begun investing in IBM PC software. They did not want to buy a cheaper machine that almost worked. They wanted confidence. If a spreadsheet, database, or business program ran on IBM, it needed to run on Compaq. So Compaq made one of the most important decisions in PC history. It built its own version of the BIOS, the hidden software that helps a computer start and communicate with its hardware. But it did this through a clean room process, writing its own code instead of copying IBM's. That mattered because it made Compaq feel legitimate. This was not a shady clone trying to survive in IBM's shadow. It was a serious business machine that could offer IBM compatibility without IBM control. The first product, the Compaq Portable, was not elegant by modern standards. It was heavy, expensive, and closer to a suitcase than a laptop. But for the market it entered, the point was not beauty. The point was that a business person could carry it, plug it in, and run IBM PC software without surrendering to IBM's pace. And the market responded. In its first full year, Compaq sold 53,000 computers and generated $111 million in revenue. For a startup in that era, those numbers were extraordinary. They showed that Compaq had not just found a product gap, it had found a trust gap. The company understood something powerful. If IBM's standard became the language of business computing, then the company that spoke that language best could build a real empire without owning the language itself. That was the good decision at the center of Compaq's rise. Instead of fighting the standard, Compaq used it. Instead of asking customers to switch ecosystems, it removed the risk of switching suppliers. Instead of trying to look cheaper and weaker than IBM, it presented itself as a premium, reliable alternative. And soon, Compaq was no longer just following IBM. In 1986, Compaq launched the Desk Pro 386 before IBM brought its own 386 machine to market. That was a turning point. It showed that IBM might have created the dominant PC standard, but IBM no longer controlled its future. For customers, that changed the meaning of Compaq. Compaq was not just compatible, it was fast, it was credible, it could move the industry forward. That momentum gave leadership a very reasonable kind of confidence. From inside the company, the signals looked strong. The market was growing, corporate buyers trusted the brand, the machines performed, dealers had a product they could recommend. And IBM, the giant that once defined the category, was no longer setting the pace. Compaq's scaling machine was built around that combination: engineering credibility, corporate trust, and a powerful reseller network. The reseller channel made sense in that environment. Businesses did not always want to order a computer from a distant manufacturer and figure everything out themselves. They wanted local support, installation, advice, and service. Resellers helped Compaq reach customers without building a massive direct sales organization from scratch. For the market of the 1980s and early 1990s, this was not a weakness, it was a strength. Compaq could grow quickly because partners carried the product into offices, schools, and businesses. The company could focus on building respected machines while the channel helped deliver trust at the customer level. By 1994, Compaq had become the world's leading PC maker. It had overtaken IBM and Apple in global shipments. The company that began by proving it could run IBM software had become the new symbol of the IBM-compatible PC industry. But inside that victory was a hidden problem. Compatibility had made Compaq powerful because at first compatibility was hard. But once the industry learned how to build IBM-compatible machines, the advantage became less special. The PC market became more open, more crowded, and more price-sensitive. The customer still needed a computer, but the customer had more choices. And when products become more similar, the battlefield moves. It moves from invention to cost, from engineering prestige to delivery speed, from brand confidence to inventory control. This is where Dell changed the game. Dell's direct model was not just a sales trick. It was a different economic structure. Dell sold directly to customers, built machines closer to actual demand, and avoided much of the delay and cost that came with layers of distributors and resellers. That mattered because computer components lose value quickly. A PC sitting in inventory is not like a chair sitting in a warehouse. Every new processor, memory chip, or hard drive can make yesterday's machine less valuable. In that business, time quietly eats margin. Compaq's reseller model had helped it scale when customers needed support and confidence. But now that same structure made the company harder to move. Machines could sit in more places, forecasts could be wrong, price cuts could hit before older inventory cleared. The old strength was becoming a drag. To be fair, Compaq saw the danger. This is where the story should not be reduced to they failed to adapt. Compaq did try to adapt. It worked to improve distribution, it pushed more direct sales, it simplified product lines, and it tried to move beyond being just a PC company. That last move made sense in the context of the time. The PC business was becoming brutal. Prices were falling. Dell was gaining power. Selling boxes alone looked less durable. If Compaq wanted to protect its future, it needed deeper relationships with large corporate customers. It needed servers, services, storage, and enterprise technology. So Compaq started buying its way up the market. In 1997, it acquired Tandem Computers, a company known for high-end systems used by major organizations. In 1998, it acquired Digital Equipment Corporation in a much larger deal, gaining services, enterprise systems, storage, software, and technical talent. From the outside, this can look like empire building for the sake of size. But inside the logic of the moment, it was understandable. IBM was not powerful only because it sold machines. IBM was powerful because it lived deep inside corporate technology budgets. It sold systems, support, and long-term relationships. Compaq was trying to become that kind of company before the PC business became too thin to support its ambitions. The problem was that this strategy pulled Compaq into a harder middle position. On one side, Dell was making the PC business faster, leaner, and more direct. On the other side, IBM and other enterprise players had deeper services cultures and long-standing corporate relationships. Compaq was trying to fight both battles at once. It still needed to defend huge PC volume in a market where prices kept falling. At the same time, it needed to integrate large acquisitions, combine different cultures, manage more complex product line, convince corporate customers that it was more than a hardware supplier. The strategy was not irrational. It was heavy. And heaviness is dangerous when the market starts rewarding speed. By 1999, the pressure became impossible to hide. Compaq reported a major quarterly loss, announced thousands of job cuts, and faced intense pricing pressure in the PC market. The company was still enormous. It still had customers, technology, and brand value. But the numbers were revealing something the market share rankings could not. Scale was no longer the same as control. Compaq could sell a lot of machines and still struggle to turn that volume into strong profit. It could own important enterprise assets and still be slowed by the complexity of combining them. It could know the market was shifting and still find that its own structure made the shift hard to execute. That is the real failure mechanism. Compaq helped open the PC market by breaking IBM's control. But once the market was open, the economics changed. The winner was no longer simply the company with the most credible IBM-compatible machine. The winner increasingly had to control cost, inventory, customer data, and distribution speed. Compaq's original model had been built for trust. Dell's model was built for velocity. And in a commodity market, velocity can become the moat. By 2001, the situation had worsened. The broader technology downturn hurt demand. Pricing pressure continued. Enterprise spending weakened. Compaq's revenue fell from the previous year, and the company reported a net loss. The HP merger, announced in 2001 and completed in 2002, was the end of Compaq as an independent empire. But it was not proof that Compaq had no value. That distinction matters. HP did not buy Compaq because Compaq was worthless. It bought Compaq because Compaq still had scale, customers, products, enterprise assets, and a major position in the computer industry. Inside a larger company, those assets could be folded into a broader consolidation strategy. Some pieces survived. The Compaq name continued for a while in HP's product lines. Technologies and business lines connected to servers, enterprise computing, and corporate PCs became part of HP's broader machine. But the independent Compaq story was over. And the lesson is sharper than a simple warning about innovation. Compaq was innovative. It made brave technical decisions. It saw the market early. It challenged IBM when IBM looked almost unchallengeable. It scaled with real discipline. And later, it made strategic moves that were understandable inside the pressure of the time. The tragedy is more specific. Compaq won the first version of the PC market by making compatibility trustworthy. Then the market matured, and compatibility stopped being rare. Once every competitor could speak the same language, the advantage moved from the machine itself to the system around the machine. How fast it was sold, how little inventory sat still, how close production was to demand, and how efficiently the company could survive falling prices. Compaq did not lose because it failed to build an empire. It lost because the empire was built for the rules that made it rise. And when the rules changed, size did not save it. Size made the turn harder.